Aloha, all of my friends, and welcome to Java. This is for the week of August 21st, 2023, although it is Sunday the 20th right now, so happy Sunday to all of you. Just hope that everybody, if you're in LA, that you're doing okay and you don't get flooded out from that hurricane, or in BC because the wildfires that are up there, and just all of the crazy things that are going on right now. So I wish you all well. For now, let's go through kind of the basics of the markets and what we're expecting forward for this week. It is quite volatile in a summary. So, looking at our favorite risk indicator that has kind of several items involved with it between the dollar and the 10-year yield, we're still in high territory, and I believe we're going to remain there. But the remarkable thing about this is that we did have sell-off on Friday, which should have brought this risk down, and it did not. So we'll be watching this because the larger story behind this is always the debt market and the treasuries. So we'll go over that later. For now, we've got the basic calendar for the macro of what we're expecting that could move these markets in a quick sense. So Monday, we don't have any Fed speakers on deck, and it doesn't mean they won't float some out if things start going the way that they don't want it to, but we don't have much scheduled Monday. Tuesday, home sales, we'll be watching. Wednesday will be the services and manufacturing PMI, as well as new home sales. But the new home sales will be for July, so they'll be a bit lagging. Thursday, we've got some official interviews from Jackson Hole where they're having their summit. We'll also get jobless claims, so this is a typical market mover. We've got our durable goods orders and then also the goods minus transportation. So we're really looking at that kind of going towards our GDP and what we're able to produce and sell. That is also for July. Friday is the big day when Powell will make his speech at Jackson Hole. That would be at 2 p.m. in the afternoon. And we're also getting consumer sentiment, which I think in reality is in the potty, but we'll see what numbers they come up with. So moving forward, there are some large things that we are going to be looking forward to. So this article says, fasten your seatbelts, global economy is heading for turbulence. It has been for some time. There's quite a few countries that have gone into recession formally. And we've also got a lot of things going on the war front, as we've been speaking about. So we'll be watching China, their data, and seeing actually what goes on there. So they've got high youth unemployment, north of 20%, and a lot of other issues that they're having while watching shipping slowing down and their trade. They're kind of manipulating their currency at the moment to their benefit, of course, trying to balance this out and keep their economy on life support as well. So we have this story because I think this one is another thing we should watch for this week will be oil. We're watching our commodities, and oil is also going to be interesting because it's manipulated through supply. So this is because of a tanker that was shown, they believe it holds Iranian oil, transferring to an American tanker. So with the sanctions and everything going on, and I don't know what this is exactly, but if this is true, and it would not shock me, that we are manipulating oil and kind of skirting between Saudi, who is not very happy with us anymore, UAE, who is also not very happy with us anymore, and we are rapidly losing our trading partners. So I think oil prices are something to watch, and then also for long term, spike in oil prices, because I do believe even if there is a correction, it will go up. That will push inflation higher. So between the inflation deflation, I am still in the camp that we will have basically our huge recession, which would be severe deflation. It's just a matter of degree before you call it depression. But we will dump with that, and that will make the dollar very strong. Holding on to cash will be very important at that time. You'll be able to buy most anything at a discount. Everything else will drop. After that, inflation is going to bite in hard. We'll have you'd say hyperinflation, but again, that's a matter of degree. So when you start having that inflation kick in again, we're going to have to watch that, and oil will be a good indicator because everything is either made from oil or shipped using oil. On that front, we got a few stories that all came out at once for the garbage lie that was sold to say that we can get off of oil if we just use electric vehicles. Well, the electric vehicle market is now in the potty. Used Teslas are on sale. They can be found easily for less than $25,000. They're now like the less expensive cars on the block. And this story was about how electric vehicles in general across the board have lost almost 25% of their value recently. On top of that, our favorite little cruise vehicle here that was causing traffic jams before, San Francisco is cutting their fleet in half. They've had other problems with driving through police tape and then also actually hit a dog, unfortunately. So they're going to have to do a little more work with these. So the electrical vehicle is not the solution as it is. I'm not saying it can't be in the future. I really think hydrogen would be the way to go. I don't know what you think. Let me know in the comments. But I think the whole EV thing is kind of coming to light. And I don't know how long it will last, but we'll see. So this is really our big story here is the treasuries and the debt market, because the debt market is really the instability that we're seeing. And if this goes, everything else will follow and cause that deflationary spiral that we are looking toward. So that would kill the inflation for sure, but then we've got another problem. So we've got several top financial experts talking about this now. One of them is Matthew Nest from State Street. He says right out, we know, quote unquote, from him, we know there's a debt problem. It's unsustainable and it's at the heart of the bond market right now, unquote. So they know that this is going on. They're all aware. We all talk about it, but it's still continuing because something just hasn't quite broken yet, but it's ready to break. So it just depends on what it is will become the black swan. So going on with this, they say that many bond bulls think these bond rates, that it's time to buy because the rates are high right now, better place to put your money. And in their opinion, because when it drops, then bond yields will drop as well. So we've got another quote actually, and this one is from Torsten Slock. He's the chief economist at Apollo. And he says, and this I completely agree with, the US government is pushing a snowball of treasury bills in front of itself, and it's getting bigger and bigger. All of that borrowing needs to be extended out into bonds with longer maturities. So basically, what happens is, let's say, for instance, you take out a loan for a car of $50,000. Well, you're only paying a little bit. You can't pay enough to pay the interest on it. So at the end of a year, instead of 50,000, you actually owe 50,000 plus the interest. Well, you can't pay that off, so you get another loan for the following year for 51,000, 52,000. So you can cover your interest as well. So that's what the US is doing with their loans. They're just rolling them into longer term loans and they cannot service the debt. And we've continued this for a long time, and that's why this debt market is so monstrous. So, to refinance all of this, um, what he's saying is that they will expect that rates will come down and real yields will head lower. So, the only difference is the US can print their own money and buy their way out. That is the monster in the corner. So I've got a couple of updates I want to go over really quickly. Germany, we know, is in a recession, and yet they just announced another 1.08 billion in military aid package. So this is the game. They have to inflate more, borrow more, spend more, and keep this monstrous cycle going. So they're primed for this. So, and we're doing the same thing. And then the other part of it is Ukraine is sending US supplied combat vehicles into battle, and they're going to be getting more aid from the US. So they can afford to do that. So we've got the wars ramping up because if the borrowing fails, they turn back to war and We're not allowed to say no to that. You must support it, even though all wars are bankers' wars. If that fails, if war fails, we will go to plague. And we've got a new variant of the cough that shut everybody down. And they're already talking about hospitalizations up. And this is to fund big pharma. So we can roll in that debt and keep spending because the public needs it. So that's all I've got for you at the moment. I probably will have more later. There's a couple of stories I don't want to get into here. But with that, I wish you all a wonderful week. Have a wonderful day today as well. And until I see you again, my friends, stay free.